Hello, my name is Rodolf de Wijs.
I'm Joost de Vries.
And we made a series of movies on corporate finance.
So, we were discussing that we have several elements that lack in a lot of corporate finance books. And we already discussed two of them. So, insolvency as a balance sheet concept was the first movie. The second movie, we discussed the nature of non-interest bearing debt. So, those were the orange blocks. And that was the second movie. And today we're going to discuss something regarding business valuation. And in this world, also the difference between interest-bearing debt and non-interest-bearing debt is very, very important. So let's take a look how this works.
So Joost, we continue our discussion on non-interest-bearing debt. We discussed it previously as a source of finance, but now we're going to discuss it from the perspective of company valuation. And the question is, how does it relate to company valuation? And I think one of the most exciting questions for corporate finance is, how do you start valuing a company anyway?
Yeah, so that's a big question. So what is this business worth? So just take a look at the mind map again and try to figure out the relevant blocks for company valuation. So Rolf, what I found out in the past is that a lot of people think that the blue block, equity, says something about the value of the business. Right,
yeah.
So
that's also how we started, right? So equity is what remains if you sell off everything.
Yeah.
So the equity value, so the equity here in the balance sheet is an accounting equity.
What you see over here, it's driven by accounting principles. So the assets are based upon the valuation that the accountant uses for presenting the annual report. The blue block is still an accounting equation, but it's based upon accounting numbers. So it doesn't say anything or much about the real value of the business. So if you go to the real value of the business, you have to take a look at the capacity of the company to generate future cash flow. So basically all valuations are driven by the perspective of the cash flows that the company can generate. So let's take a look at this picture over here. So just by stating that this company would be worth 90, only the blue block, that's incorrect. Yeah. So we make different calculations. So just take a look at what we see over here. We see a few relevant blocks for valuation. So most of the time we use the profit and loss account and specifically something which we call the EBITDA. So I'm not going to elaborate on that, but this is one of the pieces of the puzzle. And then we take a look at how much debt the company has, and it's really relevant. So how many red blocks does the company have? So over here you see in the balance sheet that this company has 150 in interest-bearing debt. Yeah? And you see that there is also non-interest-bearing debt. So we discussed the orange block in the previous movie of 90. And on the other side of the balance sheet, take a look at the cash position. There is 20 at the bank account. Yeah, so there is 150 interest-bearing debt and 20 in the bank account.
So you've been taking us through some balance sheet and profit and loss accounts. I think many people in the end, if they're engaged in corporate transactions, one of the key questions is, how much is this company worth? You told us that it's not really in the balance sheet. So how do we determine the value of a company?
Yeah, that of course is a large question. So how do you do that? I'm gonna explain the very basic concepts of business valuation. So there are always two concepts that are communicated, and these are called the enterprise value and the equity value. There's a key difference between the two, and I will show you how this works. So most transactions, they start with what we call an enterprise value first. And an enterprise value first has a very specific assumption. And the assumption is that there is no cash at the bank account of the company that you acquire, and the company has no interest-bearing debt at the same time. So we put the financing structure from cash and interest-bearing debt aside, so you just forget it. And this is what we also refer to as a cash and debt-free valuation. The big question, of course, is how do you calculate this enterprise value? So we have two ways of doing that. We've got the difficult way and the easy way. So the difficult way is the discounted cash flow. So if you take a look at our book and you go to chapter number 4, there is a very detailed explanation how a discounted cash flow works. In chapter 3, there is a very basic structure how you use an EBITDA multiple. So basically, if you would say this business is worth, let's say, 8 times the EBITDA, the concept that you calculated is the enterprise value first, right? But what is very interesting to realize, this is not the amount of money that the shareholder is going to get when he or she transfers the shares. So that's something completely different. No. And this is where you see that debt structure is becoming relevant. Yeah? So what do we do? First, we calculate the enterprise value, assuming that there's no cash and no debt, and then we go to the balance sheet, and if you find that there are red blocks, you subtract it from the enterprise value. So we saw in our balance sheet previously that there was 150 in interest-bearing debt. So we subtract it. And we saw on the other side of the balance sheet that there was still a positive cash position of 20. And in corporate finance, we combine these two. So we call this net debt. And basically net debt is the amount of interest-bearing debt minus the cash that was still on the other side of the balance sheet. So the assumption is you could have used that cash to repay your interest-bearing debt. Yeah? And then you end up with what we call the equity value. So, and the equity value is basically what people are getting when they sell their shares. So it's not the enterprise value, we have to make corrections for the capital structure first.
All right, can we maybe clarify this by using an example? Of a house or a car?
Yeah, so that's a good one. You always use the example of the house. So basically, the first one is that you say, what are you willing to give for my house? So let's say it's 500,000, right? And then the seller says, but there's still a mortgage on the house. And then probably you would ask us,
of 150.
Of 150. So what do you want to pay for the house if you also get the mortgage? Well, so that's basically, you take the 500 and you deduct the mortgage. So you're willing to pay 350. On the other hand, if there is a vault with legal cash in it, which you can use for yourself, and you get the vault with the cash as well, and there's 20 in cash in that vault, so what are you willing to pay? Well, that amount of cash. So this works the same thing as buying the house. You deduct the mortgage and you add the cash in the vault, and this is where you end up with the price for the house.
Which you actually pay. Yeah.
Which you actually pay.
Yeah. So we've got two main concepts, the enterprise value and the equity value. The equity value is what's actually being paid for the shares.
Yeah.
The equity value is a debt and cash-free valuation, basically the current value of the future cash flows generated by the company.
The difficult one is the discount cash flow. You take a look at the operational cash flows and the capital expenditures, and then you calculate what the enterprise value is, and the easy way is taking an EBITDA multiple. Yeah?
Yeah, which all lawyers could do.
Yeah, which all lawyers could do. It's a shortcut, but it works. Then the key question is, what happened to the orange block in this picture?
Where are the orange block people?
Where are the orange block people? And of course, people ask me, so why do you deduct red blocks? And why don't you deduct orange blocks? So, and that has to do with the fact about the cash flows that are attached to those orange blocks. Because in fact, what happens, if you pay a creditor, there is a new creditor arising. And if you pay one, there is a new creditor arising. And that means from a cash flow perspective, that orange block in a steady state doesn't require any cash, because once you pay one, there is a new supplier coming.
That's right? What we discussed, that it refreshes itself, right?
The orange block refreshes itself, and that means that there is on the long term no down payment needed on that orange block, because it keeps on refreshing and refreshing and refreshing. So bear in mind what we explained in the first movie regarding non-interest bearing debt. So how could we work the orange block? So what do you say to the suppliers?
You wait for another 30, 60 days.
So if you tell those suppliers to wait for another 30 days, then a very interesting effect arises in this picture. Because you don't see the orange block. And if you are able to enlarge the orange block by a late payment, then net debt goes down, because they're completely communicating vessels. And this is the interesting thing, because you can work the orange block in order to make the difference between your enterprise value and your equity value smaller, and thus having a higher equity value. So this is basically chapter 0.1 of buying a company and using free money of other people to manipulate your net debt position. So this is the relevance of Orange. So we explained how Orange works in the first movie, just by the basic movements and their legal position. But there is a far more important thing about Orange in business valuation, and it impacts the value that the shareholder can get when selling off the company. Yeah?
Thank you.